Hello friends, welcome back to part 18 in my Tesla earnings forecast video review series. I'm joined as always by my co-host Loki, who is sitting up in bed over here in the Loki spot cam looking around and not eating his breakfast. And I'll go back and share my desktop with you. So we left off on tweet number 28. Now don't get distracted or confused by the bottom half of this screenshot from tweet 28 being repeated at the top of the next tweet. So tweet 29 has the same stock compensation rows shown at the top of this page, just because there is so much material on this page, and because this is the tweet that I have to talk about how much my EPS estimate is. So Tesla reported 85 cents in Q1. That was down sequentially versus Q4, but Q4 is a pretty strong quarter for Tesla usually. And in Q1, Tesla didn't get all the production out of their factories that they will be getting out later in the year. They took a lot of deep price cuts in Q1 and honored those for a lot of folks who picked up Teslas in Q1. So I have some of that reversing over the remainder of the year. Tesla getting more production out, selling more cars, not having worse pricing, and exercising some economies of scale from places like Austin and Berlin and Shanghai, really, that are going to get record production out. Fremont may also have a record quarter. And then those may all get broken again in Q3 and Q4. Not impossible. So I'm forecasting improved EPS in Q2 of $1.33, Q3 $1.68, Q4 $1.81. You throw in the 85 cents from Q1, and that would make a full year 2023 $5.66. This is a lot higher than what the Wall Street analysts have in. It's a lot lower than where I thought Tesla would be a year ago this time, but I wasn't factoring in all the price cuts Tesla has done. Those do take a chunk out of your earnings per share. So rather than try to show you this exhibit on your screen, which is too small, I'll do what I did in the previous few videos and show you my live earnings forecast model zoomed in on just Q2 of 2023 and the few quarters that come before it, and the few quarters that I'm forecasting after it. And we'll just scroll on down and talk about what these rows are doing. These are the EPS numbers that you just saw. So there's your $5.66. You may not be able to read that summing up for you down here at the bottom. Let me move this up just a little bit so you can see what I'm talking about down there. If the display that you're viewing this on has a good enough resolution too. I upload to Twitter in 1080p and I upload to YouTube in 1080p. So if you're not able to read these numbers clearly on your screen and you're on YouTube, click on the settings icon and make sure you've selected 1080p as your display resolution, and then make sure you've maximized the screen on whatever device you're on. So that your display has a chance to show it to you in highest quality. All right, so what's this next 12 months non-GAAP EPS line doing? Well, probably the easiest way to do this is to just show you the $3.85 over here worth of next 12 months non-GAAP EPS for Q2, 3, 4, and Q1. These are the most recent 4 quarters. What was it the previous quarter? It was actually a little bit higher. $4.08 was the full year EPS for 2022. So if you believe my forecast for 2023, you believe $5.66. This is the number that you just saw in the tweet. That's coming from just summing up the 85 cents that was reported in Q1 plus what I'm forecasting for Q2, Q3, and Q4. Brad Munkin, longtime Tesla hater and short seller, is still forecasting that Tesla is going to lose money this year, as he did in 2022 and in 2021 and in 2020. He actually said you can timestamp this on a tweet replying to me back in 2019 saying that Tesla would be bankrupt by the end of 2020. That guy just can't divorce himself from the Tesla Q bear thesis. He thinks Tesla's going to lose money this year. Remarkable. All right, so here's what the next 12 months non-GAAP EPS looks like into the future if you include my forecast for next year. Brighter days are ahead, folks. If you believe my forecast, you believe bigger and bigger EPS numbers are coming. That shouldn't be that difficult to believe if you just go backwards in time and see that's what's been happening for years now, right? I only go back as far as Q1 of 2018 on this tab of this forecast model. But you can see Tesla was earning negative or next to nothing worth a full year EPS after adjusting for splits. And that's just been rising over time with that little brief pause with the Q1 2023 earnings being a little less than they were the prior year, Q1 of 2022. So that's what those rows are doing. Here's one for year-over-year non-GAAP EPS increase. So how much did the nominal EPS dollars grow by year over year? So what's this Q1 number doing? It's saying X1236 minus T1236. So if you believe the 689 is going to happen over the next 4 quarters that I'm forecasting, how does that compare against the 385 from the 4 most recently reported quarters? The answer is it's up by $3 per share. So that's a pretty healthy increase compared to, you know, the $1 worth of year-over-year growth we've gotten recently. And I've got that increasing. Then there's an earnings growth rate here. So how much has the earnings grown by? What are these guys doing? They are dividing the next 12 months non-GAAP EPS by the prior year's next 12 months non-GAAP EPS. So you go from really small numbers to larger numbers, you get really big percentages. Then once all those numbers get up to about $4 and hang out there for a while, these percentages get smaller. So that's what's been happening lately. But I've got that growing before long and getting back up to, you know, about 100% growth year over year in next 12 months non-GAAP EPS. PE ratio based on the trailing 12-month non-GAAP earnings. I'm calculating for you here. So PE ratio looking pretty attractive for Tesla right now, just below 40. For most of Tesla's history, they haven't been down in that range. They've been up in the hundreds. That's a pretty remarkable PE ratio back in Q3 of 2019. 17,000 PE ratio. Goodness, that's a lot. Against very, very small earnings numbers, right? So then there's the PE ratio based on trailing 12-month GAAP earnings. Sometimes people calculate PE ratio on GAAP earnings, including the stock-based compensation expense. Then there's one here for the PE ratio on the next 12 months worth of GAAP earnings. And this is the one where Tesla looks really cheap if you believe what's in my forecast. That this PE ratio has come down from 60 to 45 to 30 to about 25 right now before I have it going back up again. Now, we'll need a bull market to return for this PE ratio to climb by quite a lot, or we'll need Tesla's earnings to grow by a lot, or both of those things, I think. And of course, this is all for entertainment purposes only, not financial advice. Do your own research, etc. As always. Next row for PEG ratio, the last 12 months PE over the next 12 months growth rate. All right, so let's take a look at the Q4 2022 calculation here to see if we can understand what's going on. So we've got this 39% year-over-year earnings growth rate. So that's a thing. You take the 566, you divide it by the 408, that's a 39% growth rate, okay? What's the 58 doing? That is the PE ratio, price to earnings. Okay, so that's how you get to PEG, price to earnings to growth. You take the PE and you divide it by the growth rate times 100. So 58 over 39 gives you 1.5 PEG ratio. So that number is coming down below 1, which is very attractive. A PEG ratio below 1 looks like someplace that you may want to think about making a long investment. For entertainment purposes only, do your own research, etc. If that number gets really high, the PE is very high relative to the growth, then maybe you're not as interested in investing in that stock until that PEG ratio comes back down closer to 1. Then we've got a Peter Lynch PEG equals 1 price target. Peter Lynch famously believed that the PEG ratio ought to be 1, that the growth rate ought to match the PE ratio. So if you are to apply that logic to Tesla's forecasted earnings growth rate over the next 4 quarters, then you would think that these are the price targets for the remainder of this year, for 2023, that you would buy Tesla if it's trading below these dollar amounts. And you can see the ones that were actuals for Q3 and for Q4. Anything below 132 or below 158 was a good buy at those times. 304, 367, 447, 552. If you believe the earnings that I'm forecasting, that's how the math comes out. Then there is a 12-month price target, historic PEG ratio adjusted. What's this doing? It's looking back at what the PEG ratios have been for Tesla and saying, hey, if it returns to these PEG levels, then based on the earnings that I'm forecasting for the next 12 months, here's the price target that would go with that. But the time frame being referenced happened during a bull market. So let the buyer beware on that one. Those are pretty much the highest PEG ratios there have been. So you may not want to use the historic PEG ratio adjusted price targets here. And then there's Stevenson indicator. Who else? Who loves any technical analysis more than Stevenson indicator trademark Mayor Talker, who said that I should definitely trademark Stevenson indicator on one of the first occasions that I tweeted about seeing that there was a growth trend support line for Tesla that everybody saw. So that's why it was funny for me to try to trademark it as being Stevenson indicator right in the middle of a roaring bull market. But I have been very careful at all times to tell people technical analysis is phrenology, and that Stevenson indicator is definitely not a price target. But it just increases at that same growth rate that was seen on the chart at the time that I identified Stevenson indicator. If Tesla were on Stevenson indicator still, it would be trading at just under $500 by the end of Q2 2023. Maybe one day the Tesla stock price will catch back up to Stevenson indicator, and then I'll have a good laugh at everyone who tried shaming me over it being my price target, despite my repeated warnings that it is not a price target. Then I've repeated the gap net income line here. How far down should I go before I end this video? I should go as far down as automotive gross margin, excluding regulatory credits, non-GAAP. Okay, so we've got our GAAP net income repeated here, and we've got our adjusted EBITDA number. How do you get to adjusted EBITDA starting from GAAP net income? Great question. The first thing you want to do is add back your interest expense. and then you want to add back your provision for income taxes because you want to get to the earnings before income taxes, depreciation, and amortization. That's why you're adding these expenses back, as well as the depreciation, amortization, and impairment. Depreciation is the gradual expensing of capital assets over time, and amortization is the gradual expensing of non-physical assets over time. And the stock-based compensation comes back in because that's non-cash. And that's how you get to the $5.9 billion I expect Tesla to report for Q2 2023 of adjusted EBITDA non-GAAP, which I think would be an all-time record. It was $5.4 billion in Q4 of 2022, and it looks like there wasn't a higher number than that previously. So yes, that would be an all-time record, with more to follow in Q3 and Q4, according to my forecast anyway. Then I'm showing the automotive gross margin percentage here. If you look at just automotive and you exclude Tesla's other businesses, you've got that growing just slightly from 21.1% to 21.4% in Q2 as Tesla continues to manage their costs as well as they can, and for the pricing unfavorability that we saw from Q4 to Q1 to reverse maybe a little bit or just stabilize, with some improvement expected in Q3 and Q4, especially as places like Berlin and Austin get more production out and improve their gross margin percent quite a lot by getting closer to their design intent output. Then what some people like to do is throw out the regulatory credits. So if you throw out regulatory credits and say that doesn't really count because that's not burdened by costs, then you can throw it out and say if there were no regulatory credits revenue, Tesla would have reported 19% auto gross margin excluding regulatory credits, and I've got that growing by 1 point. You can see almost all of that point is just that I'm forecasting less regulatory credits revenue for Q2 than Tesla actually reported in Q1. Q1 somehow usually ends up being the highest revenue from regulatory credits that Tesla declares every year. I don't know if there's a seasonality reason for that, or if that's a coincidence, or if something of significance drives that to happen that way. But I've got, that percent of revenue declining in Q3 and Q4 as auto gross margin excluding regulatory credits revenue improves in Q3 and Q4. So that is the rest of that slide, and that is my video for today. So on behalf of me and on behalf of Loki, thank you for watching this episode. If you liked this video, don't forget to click like. If you're not subscribed to my YouTube channel, I know 1/3 of you are not subscribed to my YouTube channel. You could do that over here. YouTube gives me analytics that tell me stuff like that. And thank you to everyone who supports me on Patreon, or by subscribing to me on Twitter, or by joining my YouTube channel as my executive producers, Kathy Kitchler and Rebellionaire.com did at the highest support tier, earning them a thank you at the end of every video, and I'll see you in the next one.